Welcome to the Untitled Traders Group, and this is our 30-day stock market challenge. Believe it or not, we're on day 14. And as we look at the current market conditions, now is a perfect time to take a step back, examine your trading system, looking at your trading plans, make adjustments to make sure that you are adjusting to current market conditions, and importantly, make sure that your system actually is working and it continues to match your risk tolerance. So this week we've been focusing on technical analysis, and last time we met we talked about support and resistance, and we're going to kind of continue on that as we talk about the trend of support and resistance. We're going to talk about moving averages. As we all know, technical analysis has been around for decades, and moving averages is one of the more popular and more useful and reliable technical indicators that we have today. And again, the purpose of going with moving averages is to talk about the trend. And again, the trend is your friend. By identifying trends, the moving averages allow you to make those trends work in your favor and increase your winning trades. And so I hope that by participating in this video tutorial, you will have a clear understanding as to why moving averages are important, how they're calculated, and how we can incorporate them into your trading strategy. So to help identify that trend, traders use moving averages to keep them on the right side of their trades. But these moving averages come in different formats. They're simple, exponential, adaptive, triangular, weighted, time series, double exponential, triple exponential, and even cumulative moving averages. And although there are these different formats of moving averages, the underlying principle remains the same for all of them, and that is to help technical traders track the trends by smoothing out the day-to-day price fluctuations or the noise caused by the volatility of the stock. So what exactly are moving averages? Well, a moving average is a mathematical result that is calculated by averaging the number of past data points. And now that might make you want to take a big nap because we bored you, so we're not really concerned so much as how they're calculated as much as how they look. And as you can see here, we have a nice smoothed out 50 moving average and a 100 moving average. Once determined, once this calculation goes on in the background, the moving average is plotted onto a chart in order to allow traders to look at that smooth data rather than focusing on that day-to-day price fluctuation. So you can see that these moving averages are plotted at a nice smooth line showing the volatility of the that underlying stock. However, again, it kind of blocks out some of that white noise. As a part of our study, we're going to look at simple moving averages. We'll get into some of the other ones later, but right now we're going to focus on simple and moving average. So a simple moving average is a trending indicator that eliminates the volatility of the daily price movement. As with other technical indicators, it's based on past price data that lags the current price movement, but the information provides incredible beneficial information. Now here we can see that we have the 15 simple moving average and we have the 50 simple moving average, SMA, simple moving average, 15 and 50. And what's important to see here is that the short-term average responds quickly to the changes in the price of the underlying stock faster than the long-term. The longer term are slower to react. Again, notice how this short-term one reacts quicker and closer to the stock action than the longer term. And you'll see that that's going to be part of our trading rules, our trading decisions on how we use moving averages. Now, exponential moving average are more focused on weighted value of the stock. They're more concerned on how the stock reacted in the past current days than they are what happened at the first half of that. So here we have a 15 moving average, and you can see the blue one is the simple moving average, and the red one is the exponential moving average. And the red one is closer to where the stock actually is because it's weighting the most recent days. And they do this to try to take into account that lag that the simple moving average has. So the technical technicians use exponential moving average to kind of get a quicker signal from the moving average. So which one's better? Well, to be honest with you, neither are really better. They're both going to do the same thing. And as you can see kind of here, they both kind of will show the same thing with a little variance as far as how close one is to the stock rather than the other. I personally like to use exponential moving average for some of my charts and simple moving average on different charts. You as a trader are going to have to make your own decision on which one you find more reliable. And again, they're all going to be dependent upon the stock. Some stocks are going to work better with exponential. Some are going to work better with simple. Some are going to work with a 20, a 5, a 10, a 50, or 200. And we're going to talk about all of that as a part of this tutorial. But again, which one is better? It's really going to be a personal preference, and it's really going to be dependent upon the actual stock that you're using to gauge. Okay, so now that we've gone through the whole academia of the technical definitions of moving average and simple moving average, how the heck do we use these things as a part of our trading system? Well, again, remember, this is part 2 of our using the trend to be our friend. So moving averages help us to identify trend, they help us to confirm that trend, and along with what we did the last time, they help us identify support and resistance. They're not going to be the same, but a lot of times you'll see that they're going to line up with the support and resistance lines that you're going to draw. And they are an effective part of our trading decisions, which we'll get to as a final part of our video. So let's talk about identifying the trend. Here we have the spiders once again, and we're on a 3-month chart looking at the dailies. And it's obvious to see that this is in a downtrend. But what's important to say, and this again is what we talked about earlier about, you're going to have to determine what moving averages you like. You're going to have to determine whether or not you like exponential or simple moving averages. You're going to have to play around with it. In this particular setup, I have a 5 exponential moving average. They're all exponential in this setup. I have a 5 that's yellow, 10 that's green, blue is 20, and a 50 is red in my setup. And what you want to look for is how does a stock react when it approaches that moving average. Is that moving average a magnet? Does it draw it in? Or is it a bug repellent and it pushes it away? So in this situation, when we look at our long and short-term moving averages, you can see the 50 moving average is being resistance. It's tried, it's tried, it's tried. But as the tanking began and we push down, you'll start to notice that the more shorter term moving averages become resistance. We push back up here to make a lower high, and then as we push back down, now the 20 has become resistance. As we push lower, now look what happened. The 10 became resistance, and then the 5 became resistance. And as we broke through the 5 and the 10, that could be a part of your trading decisions, but you can see how this helps us stay in the trade. If we're looking at the dailies, this is how I make a lot of my decisions. I can look at the moving average and say we're still following that path. And sometimes I make decisions about how far away that stock is away from that moving average. Let's take a look at some other stocks. One of my old favorites here is Goldman Sachs. We'll click on here and take a look. Now here, once again, Goldman Sachs. You can see here's the 50 being resistance. We pushed down really hard, and then the 20 became resistance as we went lower. Another stock to look at is X. X has gone from 170 down to $42. That is just wow. So one of the things that we'll talk about again when we get into our trading decisions in the second part of our video is what happens when a stock tests the moving average. We'll talk about that. So here we are, we're testing the 50, then the 20 became resistance, now it became the 10, and as we come down you can see we're not breaking the 10. And then we really push down and look, now it's the 5. That's when you really know a stock is pushing. It's when the 5 becomes resistance or support, and it really came down and finally broke it earlier this week. Let's take a look at another one. Pot. Again, here's the 50 being resistance, coming up again, push down really hard. And now as we break here, again, this is where you're going to have to make some trading decisions, how your system works, because we broke through the 5, we broke through the 10, and we came up here, and you can see really the last one is the 20 and the 50. So this, you could have went short-term bullish. As a long-term plan, you would not have gone bullish on this stock. So again, what we're seeing with our moving averages is that they are telling us traders, institutional traders and traders in general use them as support and resistance. They use them as trading signals as when a stock breaks them one way or the other, as whether or not to stay in a trade or whether or not to get into a trade when we're looking for.
So this concludes our introduction to moving averages. We're going to have a part 2 of this series where we're going to talk more about the trading decisions, the trading rules for moving averages. I'm going to talk more about I share with you my short-term chart. We're going to talk about my long-term chart. 30-day challenge, AscendoTraders.com, 30-day challenge.AscendoTraders.com is where you could come and see all our videos and learn more about how to become a successful trader in the stock market. Thanks for participating.